Hey, howdy, friends. It's Steve DePoe with the Rose Realty Team. You ever think, you're going out to buy a home, either new construction or a resale, and you figure, okay, my real estate agent's got me here. He wants me to sign paperwork on my loan. It's going to be a contingent deal about me getting a loan. And where should I go? I mean, I do all my banking over here at Wells Fargo. I'll just go there for my loan. Or, I've always gone over here for a loan in the past. What should I do? What should I do this time? Because things have changed in the last 10 years. And so I haven't gone out for a mortgage in a while. So this week's real estate live for North Texas is what type of lender is right for you. So there's basically five different types of lenders we're going to talk about. First of all, retail banks. So your retail banks are your Chases, your Bank of Americas, your Wells Fargos. Okay, they do their own underwriting. Okay, so they're actually retail banks. Especially the smaller ones sometimes have lower fees. Your larger one, your BOAs, your Chases, and your Wells Fargos, they have their prices that they're fixed, etc. But the smaller banks sometimes have smaller fees because they have smaller overhead, right? And they don't have as much, much overhead that they have to pay. Their mortgage rates are going to be typically just about all the same. You can usually take a look at the index and figure out that each one of them is going to be, 0.1%, between each other. And so, with their fees, depending on whether they're a little smaller or larger, are going to be the difference here. Your credit unions, okay, so your credit unions are not for profit, and they're typically customer owned by the people who kind of buy in and have accounts there, right? So they're not beholden to shareholders or larger boards of directors like a bank does. Because of that, because they're not for profit, they typically offer more personal service, and again, their fees are lower than your larger retail banks. Mortgage banks. Okay, so mortgage banks, typically the only thing that they do is mortgages. And these are like your AmLoan and your PennyMac, offer home loans. Your Rocket Mortgage and your Quicken Loans are more online mortgage banks. Okay, they're typically a little bit quicker, and they're sometimes more lenient on credit ratings and that kind of stuff. But because they're quicker, their fees can kind of be a little bit lower than your large retail banks. And then your mortgage bankers, okay, mortgage brokers rather, excuse me. So mortgage brokers typically right now are the most popular, because they can go out and shop for a loan for you that fits your particular needs. So let's just say you have one customer comes in and they got 20% to put down. They're going to kind of look over in this direction over here. But if you're like a first-time home buyer, with you don't have 20% down, maybe a little blip on your credit rating, they're going to look with these groups of people over here, right? And so they could typically will have lower rates and better terms than your retail banks, your credit unions, and even your mortgage brokers. Okay, so the mortgage brokers are better. They kind of do the shopping for you. Sure, they have a fixed, kind of like a fixed group of people that they deal with, lenders that they deal with a lot, and so they'll go there. But they have a broader width of products that they can take a look at compared to the other groups. And at the same time, because they have a wider berth of products that they can take a look at, typically they'll have lower fees, and better rates, and something that fits you. So you might go to your retail bank and they won't take a first-time home buyer, but the mortgage broker will have a whole bunch of people that will deal with first time home buyers all the time. So they're typically, better if you want a better variety. Okay, so the important thing here is this: shop around. Okay, don't just go with your bank because you've worked with them for 20 years or 30 years. Now, this flip side to that is if you're sort of a small or medium business size owner, um, and you have a lot of funds in a particular bank, and you have sort of a personal guy that always deals with you, okay, then you want to probably check them first, okay. But Joe Schmo like myself, they don't know who the heck I am, and I'm just going to go into the system and going to get lost. And each time I call, it's going to be a different person and that kind of thing, right? So shop around, shop your retail, your credit unions, your mortgage brokers and bankers, and kind of find out what's best for you. Interesting, a survey done over the last a couple of years. 21% of those people responding to the survey said that they regret the choice of their mortgage lender. Okay, now, FYI, okay, that doesn't mean that you can't, once you get your mortgage or you get into your house, that doesn't mean you can't you can't refi Nance, in a couple of years. That's one of the crazy things in today's market right now. As I'm sitting here, interest rates are around 6.4, 6.6%, something like that, right? And a lot of first-time home buyers, a lot of millennials are saying, "Well, I'm not going to buy because the rates are 6%." Okay, two things: we're probably never going to see. I know I'm going off on a tangent. We're probably never going to see rates into twos and threes again. Fours and fives are sort of unlikely. Fives and sixes are probably what we're going to see going forward. FYI, 6.5 is typically over the last 40 years, I think, has been average mortgage rate, 6.5 over the last like 40 years. Okay, so we're right there in the medium right now. It's just that we've all been spoiled with 2.5, 2 3/4, that kind of thing. Okay, anyway, what a lot of folks don't realize today is that if you pick the wrong mortgage, maybe you did it for convenience or something like that, hold it for 5 years, suck it up and suffer through, and then in 5 years refinance. You'll have equity built up and all of that. You can probably get a lower rate. You can take out some of that equity and buy a rental property or a vacation property or something like that. But the important thing is you can refi. So the 21% thinking that they made the wrong choice in their lender, the choice isn't permanent. You can refi, you can get another lender, you can find another mortgage. It's that simple. I hope that kind of helped to kind of refresh our ideas about mortgages. Next week, we're going to talk about home improvement return on investment. Really good topic here because there's been a lot of people, number one, who have done a lot of home improvement during the pandemic, and number two, are considering doing home improvements moving forward instead of getting that 6.5% mortgage to get into a home. This is Steve. I am with the Rose Realty team. I'm gone.